So today, I want to spend a lot of time on reviewing the earnings. That's the main agenda for today's meeting. At least that's what I have in my mind. If you have anything else you want to talk through, bring it up for discussion, and we'll be happy to, discuss anything different. Of course, as always, I'll also go through some of the macro level stuff, what we saw, at least what I noticed, in this week. Anything that could be a market maker, market mover news, etc. Anything new that caught my attention, right? So that's how generally we'll go through these sessions. But the main agenda is to talk about earnings. No surprises. I mean, we are in the middle of earnings season. I thought we were done, but no. Next week again, there are a few companies that I own, few businesses that I own in my portfolio. That are still reporting earnings next week. So I guess maybe that will be the kind of, I think, the tail end of earnings. While we wait for a few more folks to join, generally we have some stragglers. What else caught your eye? Anyone? Sam, has any thought on recession? Man, Sam, this macro stuff is too difficult to predict. So I am I don't have any crystal ball, but if we indeed end up into recession, this will be the most awaited recession of all times. I mean, we've been talking about getting into recession since the start of this year. And I have a chart to talk about, where we look at what Mike Wilson had to say during the start of a year, and everyone was bearish at the start of the year because we probably end up in recession in Q2, Q3. But looking at the GDP number last week, we grew 4.9% GDP growth. That's not recession, right? So generally it takes time for these higher interest rates to trickle into the economy. So I understand that the real impact probably start to happen 9 months, 9 to 18 months later. So we still have time. But, if I keep shouting, saying recession is coming, one day, I'll be right. And that's what happened with every forecaster. Given enough amount of a time, every forecaster will be right. My neighbor's dog will also be right. Give enough amount of a time. So I don't even try to predict or forecast in terms of, especially at this macro level, because there are so many factors that come into in this macro stuff that it's a loser's game to try to predict. Sure, is Fed interest rates for the second time in a row might be another good sign for economic growth. No, it's actually the other way around, and we will talk about it when I get into macro. So, if it's a economic growth, then Fed will actually become more hawkish and try to raise the interest rate. Now we might be getting a signal that economy might be slowing. So it's actually the other way around. But it's a good sign for stock. Right? So we are back into the same mode wherein bad news for economy is good news for the stock market.
Vivek?
Sorry, go ahead.
Last Monday in the local San Mateo County newspaper, they had two articles. This is a really small paper on inflation and how people have to cut back. So that 5%, is probably from inflation.
So even if you have to cut back, or the other thing is people are still
No, but what I'm saying is our inflation has risen. Well, my sister's brother-in-law said it rose 80% since February 2022. And today I read I don't know, an article in the media. I can't remember which one, but they said only 20%. So you see, what the government records as CPI is not inflation. And like another thing, there's this guy on YouTube. He said, well, every 4 years after 2008, China's GDP decreased. Actually, growth decreased from 2008. And at least I was in Shanghai, the major city, and the inflation rate was about the same size as the reported China.
Okay, so for whatever reason, I got disconnected and now I joined back. But again, from when it comes to the US economy is driven by consumers, and consumers are still not feeling the pinch. Maybe in next two, again, I think when I talk about consumer, let's not bucket everything in one side. So people who are feeling the pinch are the ones who are in the lower strata of economy, right? They are feeling the pinch. Those who have had assets or still have a good job, they are still not feeling the pinch, and they're still spending money. Look at the Starbucks, right? Those expensive lattes are still selling. So US economy is still strong. Maybe overall, I mean, we'll go through the jobs report, which does show some sign of weakening, and that's why Fed probably hasn't raised, and that's given more hope to the stock market. But hold on your thoughts. So yeah, I mean, it's unfortunate, but bad news for economy is good news for stock, and vice versa, because the market is so much addicted to Fed drug that we need that. We need the Fed interest rates to come down. All right, so I think we have enough people. Let's dive deeper into today's session. Welcome all. This is 194th session. Let's carry on. Thank you for joining in, every Saturday. That keeps me motivated to come here and talk about stocks, investments, options, general economy, macro, micro, and learn. I mean, I love this marketplace because there is so much things to learn. Every day there is something new. All right, so let's start with today's session. First, I want to talk about, learning from others' mistakes. I'm always learning. Most of the time it is by, hey, I committed a mistake, and then you learn from it. I forgot which famous investor has told, but someone has told, right? If you don't get what you wanted, you get an experience, right? So, but it is always better to learn from someone else's mistake. So this week, I noticed that 2 of the funds closed their shops. So I just want to quickly go through that and see what are the learnings that we can derive from there, right? So one is Arch Capital. And again, these are small funds, but if you are a podcast lover, there is a podcast that I used to listen every Sunday morning when I'm driving for a game with my friends, called Chit Chat Money. And the host of those podcasts also ran a fund called Arch Capital. And when previous Sunday while I was driving, and they were saying that they are shutting down the Arch Capital, and then they went through their story of why they're shutting down, right? And I was so appalled to see that, even if, again, these are the new fund managers, these kids out of college, and then they got together, raise money from friends and family. In 2020, everyone was Warren Buffett, so they also started their fund in 2021, around 2021, and then they're shutting it down. And they're discussing their positions, like Spotify, Zoom, Match.com, and it was a concentrated fund. So again, time and again, I think I've talked ad nauseum, is position size is very, very important. Really doesn't matter whether you are a PhD in economics, or whether you've been in business for 40 years, or whether you're just starting off. If your position size is okay, you'll still survive these 2020, 35% drawdown. 2022, 18% drawdown. And if you were tech and you're still concentrated, only in tech and not taking care of a position size, it becomes tough. And those Arch Capital principals thought they were well diversified, but when they were going through their portfolio, what the major things they held in their portfolio, it's all tech, right? Having Apple, Amazon, Netflix, Match.com, Spotify, you got 17 or 20 companies, but it's all tech. It's all correlated. So again, always try to add uncorrelated assets, uncorrelated securities in your portfolio. So lesson learned is diversification from Arch Capital. Second is, I was reading yesterday, I think it came on Bloomberg. There is a fund, Trainer Ridge Capital Incorporation in Canada. And this fund actually, and the story behind this is a little interesting. So there was a general kind of a felicitation ceremony of funds where, the hedge funds that have performed well are called and they're given some awards. So the owner or the CIO or the CEO of this Trainer Ridge Capital Incorporation, he had to be there to receive the award. He didn't show up. And then later on, they figured out that he died. That caught my eye. The Bloomberg headline was around that this fund died, and the CIO or the CEO of the fund died, and then the regulators seized the fund and not trying to figure out that there are many brokerage firms which are having so many losses. So I was reading through that and I realized that, of course, this fund had a great performance. When the market is good, it's easy to get great performance when the market is helping you, when you have the tailwind of the market. And so much so that they were to receive an award for such a great performance. What no one knew is over the last one year or so, not even, it was like last 6 months or so. This fund had a tremendous performance in 2022 because they were net short. While every other fund was down, the market was down, this fund did great. And looks like they were still too short for this year. And then they started to lose so much of money. And now there was a repercussions on the other brokerage firm, their prime brokerage firm, etc. Now who are kind of stuck because they have they have some $85 million to $95 million losses. Again, lesson learned out here is you will always find someone who will be, it's like a shiny star for the day or for the season, right? It's better, I think it is more important to have consistent returns over longer period of time than trying to get the best returns at a specific period. And I have seen stories after stories of how some of these hedge funds blew up just because they didn't understand the risk or just because they were trying to extract too much from the market. Anyway, I know this is a little off. You probably didn't expect this, but I love these stories because investing is considered generally thought to be, it's complicated. You need to have a degree in economics or a PhD in finance. You need to be an accountant to understand balance sheets and all that. And I don't think. I think it's way more important. The other aspects where is not to get too greedy or not to be too fearful. So whenever I see these stories of these big funds blowing up and you try to dig deeper into it, these two aspects will come in. Someone got too greedy at some point of a time, right? Or someone got too big in their position size at some point of a time. So I thought I'll share. This is a couple of things I learned. All right, there is a lot more things that we can learn in a bad market than when the markets are good. Okay, so before we get into today's session, some previous sessions questions, I just want to make sure I answer those. I think Naresh, he had asked, is he there? Not here yet. Okay, so I'll skip this one. He wanted to know how to find the risk of early assignment. So I'd already covered that in one of our previous sessions. So I just went and found out which session was it. So I covered it in this and I posted that in YouTube. Other question was, I forgot who had asked. Sufal. The question was around what's the ideal delta? And again, we talked about it previous session. Delta, I mean, it depends on what your bullish or bearish thesis is. But I mentioned I'll bring up what Tasty Trade suggests. So per Tasty Trade, and again, those folks are 100% options. They don't have any long positions. I hold a lot of long positions, so my philosophy is different. But if you are looking for what's a option only account and what's an ideal deltas, so negative 200 to negative 400 deltas per 100K of net leak. The reason it's negative is because you are when you're sold in options, and you also have the IV goes, basically if you're sold options and the IV goes high, your positions is impacted. So keeping negative delta helps us, because if the stock falls down, then your options positions, the IV or the volatility, you have a negative impact from volatility, but you have a positive impact from negative deltas, right? The other recommendation around the theta is keep theta to be 0.1% of a net leak, means for every 100K of your account, maybe generally have around 100 theta. Again, these are not, I would say, rules to follow. I don't follow these, but there was a question, so I thought I'll answer that. This was again from Naresh. He's not here, so I'll skip this one. Let's move on to the next one. Correlation. There was a question around where do you find correlations, and I think Sri gave this chart. Sri, is he here yet? Not here yet. Okay, so I found another one. This was, I mentioned I had another website where you can actually get asset correlations. So let me put this link over here. So basically you can type in the symbols. Let's say, give me some symbols. Let's say XLF, SPY, IWM, XLV, and I want to look at the correlations for monthly return. You'll get to know, the correlations of how these different tickers are correlated, right? And it is important, like we talked about for Ars Capital, it is important to get uncorrelated assets in your portfolio. So one way to find the correlation, this website, I'm sure there are other websites that do exist, but I have used this, so I thought I'll share this. All right. Was there any other question from our previous session that I missed? Okay, I got a message. Okay, yeah, even today evening I'm busy too for the same. All right, so let's move on with today's session. So at a macro level, so this was a chart that I had shared last week, right? And then from Halloween scare to now, like, Christmas came early. This week was pretty good week. I mean, 1 week doesn't make a difference, but whatever it is, I'll take that. Everything was up. Doesn't matter. You hold bonds were up, stocks were up, Dow Jones was up, SPY was up, QQQ was up. So good to continue to stay as an investor, and that is why it is so difficult to try to time the market, get in, get out. Thankfully, I still maintain my deltas. Like I said, I was holding positive deltas, so that served really well. This week, I didn't have to manage too many of my positions, so pretty happy. So far, so good. Dow Jones was up, like, I mean, all 5 days looks like we had all 5 green days. Even the international ones, Nikkei, that's Japanese, Euro stocks, DAX, all had a pretty good week. So the question to you guys, where do you think we are in this cycle of market emotions? I know we were over this phase in 2022, and I don't know if we are here yet. I think maybe in optimism, excitement going up. What do you think? So today evening, I'm gonna be at a our community function. Probably we'll get some reading from there, because generally, depending on what people want to talk about in a social gathering, will give us some hint of where we may be in this market cycle. Any ideas, any thoughts? Okay, where are you in this cycle? What are you feeling about? No comments, no thoughts? All right, let's move on. But we will always go through this cycle, and I think as bad as it is to be in this hopelessness, depression, and I would say desperation up to depression, but these are the times when it is best to buy in the market. And I know it is easier said than done, but these so many companies are available for discount when the market is going through this phase. But unfortunately, stock market is the only market, I guess, where the buyers don't like the discount. The buyers would like to go for shopping when the market says, hey, I'm marking up the prices. Marking up the prices, that's where buyer want to buy, which is like very different. I mean, we always hunt for discounts, but not in the stock market. Lee says, I think we are in anxiety phase, right? I am generally in, what do you say? Should I call it anxiety, or always in back of my mind that I may be wrong. I'm always in that phase that, oh, I could be wrong. And that is why then I use options to give me some cushion. Ramesh says, trading, buying stocks, not gold. Gold has performed. Gold has performed nicely over, I think, let me just go to the gold. Let's pull up GLD. And this is why it's so difficult to time. I think it's 2 or 3 weeks ago, who had asked that, gold is not doing anything. And I'm like, yeah, gold hasn't done anything for the whole year. It's been just trading sideways and didn't do much. And lo and behold, looks like gold was just waiting for me to say these words. And then we see such a great rise from 168, and this is GLD, to almost 184. I think I have a covered call on this one. Well, that's fine. If it gets called away, it'll be okay. But gold has had some good run after a long time. Okay, all right, let's move on. Yeah, another interesting chart I saw was around Mike Wilson. And if you have spent any time on Twitter, you will know that inverse Jim Cramer handle, especially around the investing community. That's a parody handle, which is basically inverse whatever Jim Cramer says. Today I saw another chart which was around what Mike Wilson says. Now, I was just thinking, is it time to create another handle called inverse Mike Wilson? So Mike Wilson, those who don't know, again, he was voted the best analyst of 2022 because he was able to predict that 2022 will not be good for the markets. 2022 will be crash or something, whatever, right? So he was right. And like I was saying earlier, if you keep repeating, one particular thought process, there will be time when you will be right. And now this year, Mike Wilson hasn't performed. So let's say start of the year, he was like saying, sell any stock at market bounce. Then, by the way, Mike Wilson target for the year end is, it was 350. If I recall, I thought the start of a year, he gave a target of 350 SPY. Today, SPY was still 435. Then here, traders are being fooled. Market rally isn't the start of a new bull market. Then he gave S&P will finish the year at 3,900. And then sometimes in June or July, he capitulated, saying, okay, I'm no longer bearish. I was wrong, and I accept that I was wrong. He kept his bearish forecast for 6 months, and then he gave up. He capitulated. But then he capitulated at exactly the wrong time. Market was at the top, and then came back. Then he says SPX could still plunge 25%. And then at the end of October, he said there'll be no year-end rally. And now we are seeing markets back up. Now, I don't want to, of course, Mike Wilson is a very well-educated, well-read, and very respectable analyst. The reason, come back to the same question on forecasting, it is impossible. It is impossible to forecast what's market gonna do in short term. So don't even try. Or don't even try to manage your portfolio based on what's market gonna do this year. Some year, someone will get it right. There'll be a year when Mike Wilson will get it right. There'll be a year when Mike Wilson too will get it right. The problem is no one get it right consistently. And that is why I just don't pay any attention to these things. What else happened? Yields came down this week, and that's why we saw markets jump high. Again, it's a 10-year yield play. As long as yield kept rising, markets didn't like it. But this week we saw yield backing down from 5 to close to 4.6%, 10-year yield. So we are back into. Lee says Newton failed to predict the stock market. How could any analyst do? Now, since I talk about Newton, this also reminds me. And by the way, yeah, he's right. Newton, he invested in what, South China, not South China, South Sea company. An interesting story about Newton was he made his money, but then he got caught into the greed, and then he went back and invested everything at the top, and then lost everything. Yeah, Newton couldn't predict. 1990, late 1990s, long-term capital management. They had a Nobel laureate on their team, probably the highest amount of IQ per square feet you can find anywhere in the world, right? And then that blew up. So it's impossible to predict. All right, let's get back to macro. We are back into the same phase wherein bad news is good. Bad news for economy is good news for the market. So main things that happened this week, FOMC, we had a FOMC meeting, and the Fed decision was to keep the rate unchanged and still keep it 5.25 to 5.50%. The Fed appears close to the end of its aggressive inflation fighting strategy. We'll see what happens, in December. But Powell did leave the door open for another rate hike, possibly maybe 25 basis points later this year or earlier next year, depending on how the numbers come out to be. But after FOMC decision, then on Friday, we had unemployment numbers that came out, and the numbers were 150K, which was, considerably less than what the markets were estimating, right? So it means job market is now tightening up. Bad news for the job seekers, but good news for the stock market. Unemployment rate came in at 3.9%, slightly above expectation, right? It means bad news for individuals, but good news for stock market. US hourly wages grew less than expected. So at the end of the day, all these points to the direction that we may be looking at economy tightening, right? So then Fed doesn't have to do the job of raising the interest rate and slowing down the economy. I think it's may already start to happen right now. And that's what gave I think impetus to market, saying probably we're done. Fed is not going to raise any interest rate, not even in Q1, and the markets went higher. So back to bad news for the economy, bad news for the is good news for the market. So right now we are in the Goldilocks scenario, and that's what the market loves. Market is not too hot that we could have inflation, but not too cold that we could actually get into recession. And in this Goldilocks scenario, or so-called soft landing scenario, is what is an ideal scenario for the market. So, and I think last one is, rising supply of labor could support consumer spending, right? While reducing the wage pressure on inflation. So not entering into a recession, but not getting, going back up on inflation as well. So now we saw that the wage inflation is slowing down, wage growth is slowing down, and looking at a historical data, if the wage growth is slowing down, generally inflation also slows down. If inflation slows down, Fed doesn't have to increase the interest rate, Fed doesn't have to be hawkish. Maybe at some point of a time, Fed could become dovish and start to cut the interest rate. And just the mere fact that Fed won't raise interest rate, markets just liked it. And I know last week someone asked, what if Fed actually come and increase the interest rates in the Wednesday meeting? And I was like, yeah, if Fed increase the interest rates, market will, you'll see a correction in the market. But Fed has been signaling that they're not gonna increase the rates, or they're gonna keep it at the same level for some time anyway. So other thing which also helped the market is a weak borrowing plan of Treasury. So Treasury came and told they're not gonna sell as many bonds as the market had anticipated. So less borrowing. That means we will the Treasury yields will be lower than what market was expecting earlier. That means that's a good thing for the stock market. So essentially, I believe these are the 3 or 4 things that happened this week, and we saw it was a everything up market. Right? So whether it's SPY, which is broad market ETF, whether it is LQT, which is corporate bonds ETF, whether it is TLT, which is 20-year plus ETF, bonds ETF, or it is HYG, which is a high yield, everything goes up. There is no risk in the market, or the risk is lowering down. We saw VIX has crashed down from close to 21 to like 25%. VIX is down 25% in a week. So no more risk, or the risk is lower. Right. I'll still wait for VIX to come down before I put my, do my hedges using VIX. I think 16 is still elevated from my perspective. So this week, Dow Jones was up 5%, S&P up almost 6%, NASDAQ 6.6%. MSCI EAFE outside of US developed country 3.1, bonds up 1.7. We got a Santa gift. And if you're not in the market, you actually miss the gift. But if you have still stayed invested, you would have been happily rewarded this week. And we're going to review some of the earnings. And if you are in those individual stocks, to me, it looks like now it's giving me the vibes of like 2020s and 2021, that after earnings, 20% move has become kind of a common. There are many stocks that I saw that are reporting earnings this week, and they were like up 20%, 30% after their earnings. What the heck is happening? Why there is so much of a mispricing? Is there a FOMO going in? I know there are some investments that is happening back in because mutual funds, those who have done their tax loss harvesting by end of October, now they got some cash on their books and they have to invest. So all those mutual funds will start investing back into the market. And that's why generally we see November, December are good for the stocks perspective, for the market. Right? Historically, I think I have a chart for that as well. So investor sentiment, this is from American Association of Individual Investors, 24.3 bullish, week ending this particular week. I don't know when do they actually take the vote. Maybe this vote might have been taken at the start of the week, I guess. I'll have to go and check it. And fear and greed, we are still in fear, but I know last week we were at around end of October. Last week we were in extreme fear, so we moved up. When the markets go up, this is again little reverse. When the markets are up, markets are at a high, then we should be actually fearful because the risk is elevated. But I guess it's the other way around. So seasonal Santa Claus rally, I had shared this chart last week also. 66% of the times November has been positive, and 75% of the time December has been positive, right? And the average returns have been 1.44 and 1.55%. So some seasonality to the market. That's also causing the stock market to go up. Looking at another chart, November to December from 1980. So this is almost 42-year chart. On an average, 3.5% stock market returns for November and December. So there have been a 2018, everyone remembers, we had a crash, kind of a mini crash in the market. 2000, there's a huge one, but majority of the time, like November, December have been up and average 3.5%. Again, corroborates the other chart that we saw. So that's why I still love to keep my positive deltas. Just, who knows? Again, I don't know whether 2023 gonna be positive or 2023 could be 2018, could be 2022. I have no idea. But right now, history is 75% of the time. And I would like, I would like to take that 75% bet. Okay. All right. And yeah. Should be fear correction. I also shared this last week. Just reiterate. An average decline of 14.5% has happened from peak to bottom in 18 corrections. So we were in correction mode at the end of last week, but we are no longer in correction mode right now. We are out of correction. So what's next? Like I said, tax loss harvesting is done. Mutual funds are now getting back into the market. They have the capital available and they can't just hold cash. They have to invest. So I'm not going overboard for now. I'm keeping my deltas in check. I believe this week was too much of a positive reaction, too much too soon. Only time will tell. But yeah, don't be greedy. Don't be fearful. So that's a game I'm gonna play. So next week, a lot of earnings still there. Now let's see what I'm interested in. Berkshire Hathaway. What else? We got Uber. So I'm gonna review maybe Uber next week. Celsius has been crazy stock. The business has also been doing really great. What else we got? A lot of 2020 favorites: Toast, Upstart, Roblox. Okay, Disney. Not too many. At least, okay, Unity, Trade Desk. I guess these are the ones for my portfolio. Oh, Oatly still exists. I'm surprised. Any of these you're interested in covering for earnings? Yeah, I guess we got 3-4 earnings for the next week. All right, buys or sells this week. Bought a couple of few SEHD and Google. Didn't sell anything this week. And since this is our first meeting after the end of October, and after the end of every month, I do come and share what are my top holdings in my portfolio, just to be transparent in terms of what I hold. I didn't see much change. The top 15 are still the same. Probably the ranks have changed in between. And I'm sure after the earnings, yeah. Oh no, I think even before earnings, MercadoLibre was top, became top, then Apple. Yeah, so nothing much change. Any questions on top 15? Still holding some good amount of cash. It always helped me to sleep well. SPY is number 2, MercadoLibre, Apple, Microsoft, Meta, Amazon, QQQ, Google. This is high dividend ETF, Gold, ASML, Berkshire, Shopify, IWM. That covers top 10. I still have more than what I want to hold in my portfolio, but we'll clean it up. Some of them are dust stocks, so probably the number is higher, but I don't have to spend time in all 68. Many of them are ETFs. And unless I build my conviction in a particular sector, or we become educated enough to be able to understand the sector, I just don't want to take chances on individual companies. All right, other thing is, I don't think we ever talked about a crypto economy for many weeks, but I do want to talk about this week. There's a lot of stuff happening over there. Bitcoin, again, is like up 108%. That is the biggest asset, if you consider it as an asset. And I know there are different viewpoints around this. Could be a lottery ticket, it's just a joke, it's just a scam. 2, it's going to change the world. And I don't care where you lie on the spectrum of scam to the change the world. Every individual is different, but there's been, some stuff happening over here. And you may be able to see this showing up in your 401ks. So whether you like it or not, maybe you should spend some time to learn about this, right? So Bitcoin has been on tear this year. Another one is there are favorable tailwinds on a GBTC because Grayscale won the lawsuit against SEC. That shows up in the GBTC. At the start of the year, it was selling at a discount of 45%. Now they've covered up almost 30%, like almost 32%. It's up 32%. GBTC is up 32% since the start of a year, right? Why all this? Why the crypto market is back on CNBC? It is because everyone is hopeful that we'll soon have a spot Bitcoin ETF. That is the only reason. And when the second is there's a halving coming up in a Q1 of 2024. That means the supply of the Bitcoin is going to be cut in half. And if your supply is going to go down and if the demand is going to go up, what's the prices will do. So that's, and the third last thing, which is that I found yesterday on Bloomberg, and I didn't realize this, that there have been accounting changes that have been proposed on how to value the Bitcoins that some of the companies hold on their balance sheet, right? So I'll take a minute to explain that, why, what the current rule is and how are they gonna, the proposal is to change it. So if for a company, like for any investments that companies hold on their balance sheet, they're generally valued at a fair market value, right? If you go and look into the Berkshire Hathaway results, Berkshire Hathaway has got some businesses that they run, Geico, plus it's got a bunch of investments, right? They got investments in Apple. 50% of Berkshire investing portfolio is Apple. They got investments in Coca-Cola. And when they report the results, they have to report the gains or the losses from those investments based on what the current market value of that investment is, right? And that's what the accounting rules are. But when it comes to the Bitcoin, any companies that hold the Bitcoin on their balance sheet, the treatment is different. It is not reported at the current value of the Bitcoin. So, and the way it is today, the way it has to be reported is if you bought a Bitcoin at, pick any number, let's say if you bought a Bitcoin at $30,000, if a company bought a Bitcoin at $30,000, and if a Bitcoin has fallen down to 20K, they have to take a loss or impairment charge of 10K on their income statement. Okay. Now, if Bitcoin comes back to 30K in the next quarterly result, they can't take the gain of 10K on their balance sheet, right? Or if a Bitcoin goes to 60K, they still can't take the gain because the Bitcoin or any other crypto asset till today, they are not mark to market on the financial statements of the companies. But now this rule will require, and I don't know when this will be effective. Oh, this rule is set to go effective in 2025 annual reports. But that would require businesses to use fair value accounting for Bitcoin and other crypto assets. I think, I don't know. I mean, if I were a company, were to own these things on my balance sheet, it actually hits my income if it goes down, but I can't take the gain if it goes up. So it's like heads you don't win, tail you lose kind of a scenario today. But if this gets into effect in 2025, that will be good for companies. Yeah, that's all on the crypto side. Any questions still so far? I'm too fast? It's okay? They're interested in this, or is it not useful? I mean, you guys come here for 2 hours. I just want to make sure that this is useful for you. All right, let's move on then. What else I saw? Yeah, this one. 2023, and I've talked about this earlier also, it's been bonanza year for the ETFs that have now started to invest in options. Okay, thank you. Gata says, newbie learning, you're welcome. Sachin says, useful. All right, I'll continue. Yeah, give me those vibes, right? So I know, okay, what am I saying is at least useful for someone. Otherwise, it's like, becomes boring. All right, so we talked about some of these, right? JP, which gives you 10% dividend yield, QYLD, GEPQ, and then there were others that those zero risk strategies or zero risk ETFs that we've talked about earlier. And I started to see all of these coming up more and more in the news in 2023. And of course, why not, right? Because your interest rates being higher, the calls are expensive, and then you could actually sell covered calls and generate some income. And wherever there is money to be made, these financial services companies will start to create a products for retail investors. Okay? And in 2023, I've been seeing a lot of chatter about these yield enhancing ETFs. In 2022, we saw a lot of the ETFs which were using collar option strategy, and I brought all of those for discussion. We also saw a lot of annuities companies offering such products, and they were charging like 75 to 150 basis points just to do the stuff that we discuss here, right? How can you basically protect your portfolio, zero cost insurance, and still have a little bit of an upside and all that collar strategy and everything else. Now, JEPI does exactly, basically, they are selling a covered call against the SPX. And when you sell a covered call, you can actually make 10 to 12% over a year, provided you know how to manage it. But of course, not every retail individual investor wants to do it or understands it. So we see more and more products coming in. So much so that is option selling ETFs are now starting to boom. Right? It's almost $60 billion of money has now moved into these option selling ETFs. So JEPI is one of the biggest one. And essentially, there was nothing since 2021. And then we saw this trajectory of suddenly market warming up to create generate an income by selling options, and then creating a products that can then be sold over to retail investors. And here's something new, right? So many more, of these ETFs, even this year, right, have already related to options income. So if you are new to options and you don't want to manage on your own, these are some of the others that you can use. But please understand, there is no free lunch. If you are generating income through options, you're giving up something, but you just need to understand what's your trade-off. Right? So JEPI gives you almost 10% dividend, but then it has underperformed the overall market. Right? You got your dividend income, but then your capital appreciation, it's actually down by 1.62%. Whereas SPY, let me just bring up SPY. So JEPI is down for 1.62% for the year. SPY is up 14%. So, and because there is an interest, a lot more products will come in the market. And I don't know if you're using a financial advisor or anything, they will also try to sell all these products. But please understand the trade-offs that you are making and when you're using such products, right? If you have questions, come and ask here. We'll be happy to discuss. Yeah. So far, like $60 billion retail investors are ready to put in. And especially after 2022, everyone says, okay, I want some standard income. And if you ask anyone, say, are you ready to give up a bit of an upside for, downside protection? Yeah, why not? Right? But if the market goes up 20% and you're made only 5%, then you will go back and say, what the heck I did? I didn't make any money. So understand what you're getting into. There are a lot of such products I see coming into the market. All right. What's next? WeWork. So the reason I bring WeWork for here is that, again, stuff to learn from WeWork. So WeWork may enter into Chapter 11 bankruptcy. I mean, I had so much fun talking about WeWork in 2020, 2021, when they were trying to push it to retail investors via IPO at $47 billion. So you can't believe, whatever the analysts say or the Wall Street says, everyone had their own ulterior motives. They wanted to push WeWork to us at $47 billion, but when that didn't work out, they were not willing to buy WeWork themselves at $8 billion, right? So, but at the end, the WeWork chapter may close next week Okay, I got a message, internet connection is unstable. Is audio okay or is it breaking up?
It's great.
That's great. Cool. Thank you.
Can I talk about WeWork for a minute?
Sure.
I went to a conference, the first Wired conference in San Francisco,
Mhm.
and I went to an HP WeWork. That guy had only worked at WeWork for 8 months.
Mhm.
And I'm sorry, after I saw him, I had such a bad taste of WeWork. They're so unprepared. I mean, 8 months to tell the history of WeWork is ridiculous, and he was unprepared.
So I mean, so WeWork as a company is crap. WeWork as the product is great. I mean, I have my previous company, we didn't have our own offices. We were like 100% remote as a company. And whenever we had to meet, so we had a WeWork pass. So we'll go and meet at a WeWork locations, right? And I love those locations. You know, you can get a desk and these are all well stocked with coffee and all that stuff. But as a business, it's a crappy business. I mean, we don't have to get back into WeWork. We have discussed during the heydays of WeWork. Essentially, WeWork got themselves tied into long-term liabilities, and they were generating short-term assets, right? They signed up long-term leases with the landlords for 10 years, 20 years, and the way they were trying to pay for them, those long-term leases, is trying to rent out the spaces to and the desks to smaller companies, startups, even the bigger companies, but those are like short term. You know, you might want a desk for, you might want an office for next 6 months or a year. Many of the startups die. And that's what happened in 2022. Startups started dying. No one wants to rent out anything, but then your liabilities are stuck. It's a classic mismatch of timing. Right? In our 4 sessions earlier, where we were looking at the whole investing process, one thing I talked about that is very important in investing process as an individual investor is your time management, time scale management. Make sure you're investing for the time period that when you need to enjoy the fruits. If you want to invest, if you need money in next 6 months, pick up the vehicle for the next 6 months. Don't pick up a stock market, which is a vehicle for 10 years or 5 years. Your assets and the liabilities have to match your needs, and your investment vehicle has to match. And WeWork did the biggest mistake of mismatching of the time duration. Anyway, it was just a real estate company. It wasn't a tech company. Doesn't matter what Wall Street was trying to sell as a tech. I think their mission statement was to raise world's consciousness. So this chapter will be closed. It's sad to see it go because the facilities were great, but yeah, the business model was crappy. All right, last chart. Oh no, I guess last chart before we jump into earnings is this is interesting one. Investors are their own worst enemy. If you look at a 20-year annualized returns by asset class, like CAGR, 20 years CAGR, REITs 11.2%, emerging market equity in 10%, SPY 500, you don't have to do anything, right? You don't have to attend this session. You don't need to know what's a balance sheet is or what's a cash flow statement is. Just go and buy SPY. Still, it returned 9.5% CAGR. Right? Still, on an average investor, they still made only 3.6%. It's all because the reason why the average investor made only 3.6%, whereas you could have just picked S&P 500 and done nothing, you could have still made 9.5%. The reason is we're trying to time the market. We get out at the worst, average investor gets out at the worst possible time when the markets are low, and enter back into the market at the worst possible time when everyone's talking about the markets, when everyone's feeling great about the market, when we're feeling it's euphoric about the market, things gonna always look rosy, the future looks bright, and we're willing to pay more, more for what it is worth. So a reminder, We are our worst enemy. Keeping our emotions are our worst enemy. Unfortunately, not much is being talked about psychology or emotion then when it comes to investing, but I find it way more important than your IQ, than whether you are able to analyze the balance sheet or not. Keeping check on emotions is way more important. Knowing yourself is way more important than knowing a stock. So last one, so what we should do as an investor? Invest like a farmer, right? Don't shout at the crops. Farmer plants the seeds. We buy the stock, right? And then like, oh, why is it not going up? You're crazy. Right? Don't shout at the crops. Don't blame the crops for not growing fast enough. And don't uproot them before they have had a chance to grow. I think this is what many investors are guilty of. I don't think I have a chart anymore, but I saw one chart which shows the average holding period of the stocks. And I would say these Robinhoods or any of these mobile apps also have some blame to take. Average holding period of the stocks in individual investors have come down from 7 years to 7 months. Just not patient enough. And the fact that it is so easy to buy and sell the stocks at a tap on your mobile phone, on your cell phone, or on your on your app, it's made it worse. So if we fiddle too much, basically every month we'll try and we don't go to our garden every month and try to dig through and see, oh, is the seed growing? Has it germinated or not? But we do that with our stocks. Stocks, we do it every day. But that's a sad part. As a farmer, we should choose the best plants for the soil, means we should get the best stocks in our portfolio, irrigate and fertilize them, reduce their cost basis, nurture them, maybe add more, remove weeds and water the flowers. I'm also guilty of this, culprit of the still hold weeds in my portfolio. And most important, remember, you will have a good seasons and a bad seasons. 2022 was a bad season. 2023 so far is a good season. You can't control the weather. I don't control the markets. Market is supreme. I don't know where the market is gonna go. Only thing is, wherever it will go, I'll be ready for it. So build your portfolio to make sure market is down 20%, you're still not out. I mean, I weathered through 2018, 2020, 2022. Consistency is way more important than coming out on the top of the returns chart for one particular year. Just be prepared. And I don't know, no one knows where the market's gonna go. And lastly, when it's not a planting season, seeds are available for discount, and that's the best time to buy it. 2022 was a great time to buy a lot of good stocks. All right, so that's it for today. Before we jump into earnings, I have a lot of earnings to cover. But give me a moment. Let me sip some water. Give some rest to my vocal cords. If you have any questions, put it in the chat. We'll start on earnings. Probably spend next 1 hour. I think I have 5 or 6 stocks I want to talk about for earnings, and that will be all it. I see a comment. Kishan say need to digest the information. I've had questions asked. Yeah, again, I try to bring in. I'm here only for 2 hours. I try to condense and present all what caught my eye. Understand your perspective, precious. Thanks, Sam. Kata says a lot of questions, but hesitating to ask till I get at some level. So here's my response. No question is a bad question. Probably from your questions, other will also learn something. So feel free to ask. And if I realize that maybe I've already covered it, then I'll point you out to, maybe which session that I've already covered it. So don't hesitate. I mean, at the end of the day, we all here to learn from each other. Ramesh says ETF are low volatile, low return, but safer than stock options. Here's my thing. So if you are into individual stocks, and we covered it in previous session. If you are in individual stocks, make sure you have time and energy to know about the company and follow the company through earnings. See what have they done in earnings. If not, ETFs are great. Right? There is no need, and you have said it very rightly. It's a low volatile, low return, but QQQ is up what? 30%. I mean, it keeps going up and down. Is up 39% for the year. That's not low return. So you can still get tremendous amount of good returns even on ETFs, QQQ, SPY. So great vehicles for individual investors. And I would say unless you have a time and energy and more important proclivity, your interest in following up individual companies, the ETFs is the best way. Can we start invest as it's good time to enter into the market? So best time to invest was yesterday. The second best time is today. Again, I don't want to time the market because it's never works. But the idea is don't put everything in the market at one part of a time. Spread out your investments. Take the first step. Doesn't matter whenever. I mean, it was at the start of this week, I just bought for my daughters, in her IRA. And she was again saying, should we buy or not? I'm like, you got a 40 years out of you, kiddo. Right? And I don't know, Gata, about in terms of what's your need are, but minimum 5 to 10 years is what, if you're investing stock market, that should be the minimum time period. Then I don't care. And like I say, for my kiddo, we just added into our Roth IRA. And I'm like, you have 40 years, you don't have to worry about if the market is right now at the top or not. Right? There has never been a 20-year period where the market has lost. Yeah, prefer Vanguard ETFs for low fee. Yeah, Vanguard ETFs are low fee, but I don't prefer Vanguard because I prefer straight street ETFs. Those started with X's because Vanguard ETFs, they don't have good options. I don't see liquidity in the options market for the Vanguard ETFs, so I don't trade Vanguard ETFs. So I trade straight street ETFs. Can we get advice, hard-earned money, and we are, yeah, I don't give personalized advice, but maybe, to send an email, we can get you to call. But again, the idea is if you don't need that, make sure you don't need that money for next 5 years. I personally don't invest anything in the stock market which I need for next 3 years. So 3 to 5 years is a minimum. And then the best vehicle to start is SPY. And then don't look at SPY for next 3 years. I mean, there is no rocket science. I mean, it's that simple. All right. Yeah, and if you want a bunch of other ETFs, I remember when I started my investing career in US, I started with 5 and then moved to 7 ETFs. And I had only ETFs because I had no time and I didn't know individual companies. I was pretty new to the country. So I didn't know how the stuff works here. But yeah, SPY was one. I think SPY QQ. That time I had a Vanguard ETFs, VEA, GLD. There were 5 or 7 ETFs. That's all I did. Every month, put $100, $200, some allocation I decided, and do it month after month. We don't have to complicate. All right, so the earnings that I have today, I want to go through is Pinterest, MercadoLibre, Airbnb, Palantir, Apple, Shopify. There were a few more. I mean, I hold in my portfolio, but I just didn't have time to get through the others. All right, so let's start with Pinterest. Bring up my Pinterest. All right, Pinterest. So Q3 revenue grew 11%. Okay, so maybe there are a lot of new folks, so should give a little bit of introduction of the company. So Pinterest has been around for quite some time. It's a social media company wherein it's generally more used. The demographics is more used by females than males. You if you have some ideas you're looking for in terms of, you know, how should I put it? I want to decorate my room. I want to decorate my desk or a particular corner. Give me some ideas. Give me some craft ideas, some art ideas. You can go to Pinterest, search for those ideas, right? And we've been talking about Pinterest ever since day one for almost 3 years. And my only thing was, guys, this is a place where you go with an intent to buy, and you won't mind seeing ads shown to you. This Pinterest is a place where the ads are not intrusive. And I was like, when are they going to monetize that? So good to see in the last 1 year, they started to focus on monetization. So Q3 revenue grew 11%. Gross monthly active users increased 8%. And this is good because last quarter, I think it was previous quarter, they actually had a decrease, in MAU. So now they're back to the growth. Let's read what the CEO had to say. The CEO is new. New means a few quarters old. We continue to accelerate the business in Q3, said Bill Reddy, CEO of Pinterest. He actually came from Google. So that time we knew that they will find a way to monetize it through ads. We're driving strong revenue performance, robust growth, MAU growth, substantial margin expansion as we lean into Pinterest's unique differentiator as a visual search, discovery, and shopping platform. We are finding our best product market fit in years. Our users are engaging deeply, and we are delivering best results for advertisers through improved measurement and innovation across full funnel. We are making significant progress and are continuing to execute on opportunity ahead. So looking at the key numbers, and this I started doing from this quarter onwards, to try to capture, apart from the financial numbers, which I guess you can find in balance sheet and in the financial statements, key business metrics is what I'm more interested about in terms of how the business is performing. So global MAU, if you really look at from 2021 to 2022, there is almost no growth. So the market really didn't like Pinterest. And I know 2021, the stock was like 40, 50, 60 bucks, got punished because there's almost no growth. But good to see the growth returning in 2023 with 482 million. The growing majority of the growth is actually coming outside of US, Canada, and Europe. Its majority is coming from the rest of the world. Let me see, this is because from 230 to 258, this is where the majority of the growth is. Other thing to note, which is important, is also they are not only they're growing their user base, they are also being able to monetize it a little better. So average revenue per user is also growing. Right? And of course, the US is the most important, or not US, the North America is the most profitable with a ARPU of $6.46. Rest of the world is not that profitable. So revenue grew 11%, gross margin 77%, which is great. They got a free cash flow of $193 million. They don't have any operating margin. So something probably will dig deeper to see how they are able to generate free cash flow. But after 2022, every company is now focused on generating free cash flow. Key trends: global MAUs increasing, ARPU stable, revenue kind of stable, cash flow is fine. So I don't have any other concerns. So, but the bigger question is, how did they get net profit? And I've seen this on many companies now, that if you can generate 5% on treasuries and you're holding cash on your balance sheet, you can get some good net income. And that's why this operating profit was negative, but they still have a net profit positive because of the interest that they were able to earn on idle income. Their active users are all-time high. And what else? Yep. Company is changing their focus now, at least with the new CEO. They're all pretty much, oops. Oh, come on. Okay, with the new CEO, they've told investors that they are now focused on growing. They basically have 3 focus areas: growing users and deepening the engagement, focusing on growing ARPU, and driving profitable growth. So no more growth at all cost, but it has to be profitable growth. What else? Gen Z users are the fastest growing and most engaged. They've changed their product to have a direct linking to the merchant website. So now so far Pinterest will show you the ideas, but then if you have to buy, you have to go to the merchant website. Now what they have now started doing is, if you see let's say an idea to decorate a corner of your room, and it'll show you have a table here, a table lamp, and maybe some hanging decoration. You can actually go and just click on it, and there will be direct deep linking into the merchant website where you can go and buy it. Or I think, and the next one, what they're going to do it, you can actually buy it on the Pinterest itself. So they are already doing this, preparing for cookieless world. By the way, Google had announced that they will be getting rid of cookies. They had pushed it out by a few quarters. I think their first announcement came in 2021, and they've been pushing it out, but eventually it will happen. And you'll see all of these companies which are dependent on ad revenue have to figure out how to live in a cookieless world, right? Whether it is an ad tech company or whether it is a social media company, because now if there are no cookies, you don't know where the user has been. So then how do you show them relevant ads? So all those business models have to be revisited. But Pinterest is already preparing for cookieless world by doing a direct implementation with the advertisers, right? They also had Amazon Ads partnership that they announced last quarter. So far, it's working good, and seeing a good traction from China-based retailers, right? Mostly Temu. So Temu, I heard about Temu in Amazon call, heard about Temu in Apple, heard about Temu in Pinterest. Now I think I need to go and explore Temu. Anyone uses Temu? Have you bought anything at Temu? I've seen its ads showing up, the banner ad showing up, but I never bought anything. Does anyone have any experience to share?
It's cost effective. That's what people say.
Yeah, I think I agree. It probably will be.
We tried to pay, but actually it's first time recent last week, but we didn't proceed further. We can see cost effective many things there.
Okay, yeah, I haven't tried, but this is coming up in multiple earnings calls. Okay, I saw hand was up. Okay, it looks like.
Yeah, I made a small purchase because I was very skeptical of the prices in the process, but it was a pretty good experience. They delivered before they had told me, so I think they definitely beat my expectations. But again, it was a small purchase, but it looks like they're pretty organized with their products.
So Maybe I'll spend some. Yeah, I haven't bought, but looks like they are actually advertising it really heavily to US customers. So guidance, Pinterest expect to grow its revenue from 11 to 13% from a fourth quarter of 2022. Overall, my thought process, yeah, Bill Reddy is making changes. So not a change, he also is controlling the cost, staying away from other non-core interests for now, which is good. I just want to give them more time and hold the stock in my portfolio. So that's on Pinterest. Any question on Pinterest? Ramesh says one thing, buying different ETF is kind of a diversification. Some ETFs have the same story. Yeah, QQQ, so QQQ, SPY probably have that's where your correlation matters. They are highly correlated. That doesn't give much diversification. Temu is Chinese, may be risky, possible. But people have a TikTok on their phones. So they should be okay with Temu then. No, really, I mean, it's such, yeah, to try it because it's coming up in, just like Ozempic is coming up in every earnings call. I don't think I own any food company directly, otherwise we would have talked about Ozempic. But it's been crazy how many CEOs are coming and talking about Ozempic. I mean, to me, it looks like every company today can take an excuse of, yeah, we see some headwinds from Ozempic. That's become a standard de facto. So I understand about food companies, but even the other companies like Walmart, yeah, will be impacted by Ozempic or that GLP-1 drug. Anyway, that was Pinterest. Any questions? Otherwise, we move to MercadoLibre. Again, for those who don't know, MercadoLibre is not a name actually known in US because this is a Latin America based company. It's not a US based company, but a wonderful company to own. I've talked about MercadoLibre for quite some time. This one was another blowout quarter from them. Their GMV is up 18% to $11 billion. So MercadoLibre, for those who are, okay, let me just initiate for the new ones. MercadoLibre is a e-commerce player, e-commerce payment, and the logistics player in Latin America. So generally it is called as Amazon plus PayPal of Latin America. So they have a businesses, which is of course e-commerce business. Then they have a payments business. They have logistics business, and they have a credit business wherein they offer loans to merchants. Those are four big businesses that they have. So GMV is okay, not the growth. So GMV is $11 billion, a good growth from almost $8.5 billion. Take rate is 18%. What I want to focus is on commerce take rate, right? Because that's essentially is what coming to you as a revenue. GMV is the amount of a goods sold on their website. And then the take rate is, okay, if you sold $100 worth of goods, if you made only $10, then your take rate is 10. So good to see that not only that they're growing their GMV, but they're also increasing their take rate. This is total payment volume, basically the amount of the value of the payments processed on their platform. Handsome growth. More importantly, I'm interested in saying TPV, which is off their website, and which is, I don't think there's anything which is parallel of that exists in US, but MercadoLibre have they have their payment platform that it's like, what should I say? You can go to Starbucks and pay through Amazon Pay, right? Or yeah, go to any other shop, your local shop, and then you're paying through Amazon Pay. So that's the TPV off is the amount of a payment not on their platform, but on other retailers. Okay, total payment transaction numbers, 2.5 billion transactions, credit portfolio, 3.4 billion worth of credit. Last quarter, they had some concerns around this in terms of whether the credit was, how much a loss is, that's right. But now this quarter, it was all good. Unique users continue to increase. What's that was not on my radar so far, but now it is their ad revenue. And I wasn't paying attention to their ad revenue, but there's a report that came out from JP Morgan on maybe this could be their next growth engine. Basically, the ad revenue could be their next growth engine. And then I started looking at the numbers of the ad revenue, I was surprised. So from 2021 to 2023, in 2 years, the ad revenue is already became 3x. So sometimes it's good to identify these dark horses earlier in the cycle. Like you talked about YouTube as an advertising giant in Google before it became a giant. Services for Apple, advertising as a revenue stream for Amazon. It's only now I see the market actually acknowledging that advertising could be big for Amazon. But we've been talking about it since 18 months. And now I see MercadoLibre is also following the same with the good growth in ad revenue. And it's a very high margin business. That's what excites me. Revenue is up 40% year over year. So it's at 3.7 billion, still growing at 40%. That is great. By comparison, Amazon's revenue is it's in 12%. With a decent gross margin of 53%, $6.5 billion on their balance sheet, which is good. So net, I'm still pretty bullish about this company. And this is not a big company in terms of their market cap. It's a 60 or $70 billion market cap company. If you look at it, $70 billion. Management commentary. They have a new product called Meli Plus, which is similar to Amazon Prime. I'll skip the details. On the logistics side, they opened their first regional fulfillment center in Rio de Janeiro. We also expanded one of our facilities in Sao Paulo and preparing to add new fulfillment centers in Mexico. So if you look at that, so this is a company that operates in multiple countries in the Latin America. Argentina was the prime, but now they're expanding in Brazil and Mexico. And these two countries are growing like crazy. On-time deliveries had hit record levels in Brazil, Mexico, Chile, and Colombia at the same time as we improve the delivery promise on our product pages of all geographies. We're also pleased to see buyers adopting our innovative delivery options, including Meli Delivery Day, which is just like, so to me, it looks like more of a just copy and paste Amazon playbook. But of course, they are doing more than what Amazon does. But same thing, in Amazon, you can choose when you want the goods to be shipped to you. You can get a lower cost. Amazon doesn't give you lower cost because for Prime, it is anyway free, but they'll give you a free digital, credits to use for a digital goods. So now I see Meli doing the same thing. On their credit business, they have been investing in their credit capabilities. Now they also started a credit card product in Brazil and Mexico. Total credit card, total payment volume has increased $1 billion for the first time, which is good. Like I said, Brazil and Mexico, they are growing fast. And net summaries, I think it continues to just execute. I don't have much to talk about it. It's just been doing what it says and continues to do it year over year, right? GMV is up, TPV is up, users are up. Sometimes, the results are so consistent. Sometimes it gives me feeling that, are these are they fudging the numbers? Because every quarter after quarter, they just continue to deliver. Right? Advertising revenue should keep an eye. It could be a big driver in future. It's a high margin business and will positively impact their margin profile. Not that they are, what's their operating margin is 18%. So not that they are bad, but it could become even better. Just keep an eye on the advertising business. Yeah, revenue increasing, operating. So this time they had an increase in revenue as well as the increase in operating margin, means now they started to get their operating leverage. Income from operations became 685 million, grew 131% year over year to a new quarterly record and highest ever net income. There is nothing not to like in this quarterly result. In a previous one, I was a little concerned about their credit portfolio. This year, not so much. One area of concern that I probably have is they're not talking so much about their NVO's product, which is a logistics one. Mostly they are using their logistics for shipping their own goods, but I guess that's not a big deal though. All right, any questions? How many of you actually own this? I see a comment, Melly jumped from 980 to 1300 plus in 3 weeks. Yeah, stock has been to multiple places. I mean, the stock has gone to, so at some point of time, it was 2000 and then it came down to 1100. So just at the start of the year, it was around 815 and just stayed sideways for quite a long time. I think highest 52-week high is around 1451 and now it is almost 1400. But stock will take its time, but I think I just focus on business. Business just continues to do well. Yeah, it meets the audit criteria, but again, so was Luckin Coffee, but it was a Chinese company. So probably I think we can cut some slack to Melly. But yeah, it's a great business. So now it has become a biggest portion on my portfolio after this jump after the earnings. All right, any questions on Melly? The next one on the line is Airbnb. So let's bring up Airbnb. All righty. So what do you see in Airbnb? Q3 marked another quarter of strong results. Nights and experiences exceeded 113 million, growing 14% year over year. Revenue was 3.4 billion, growing 18% year over year. Remember, Melly was almost 3.4 billion, but growing 40% year over year. Net income of 4.4 billion or 1.6 billion, excluding one-time tax benefit. So this you have to take with a pinch of salt, because the net income is 4.4 billion, but majority of that net income is coming from tax on deferred assets. This is the second company I've seen have utilized that. I'm not a CPA, but if anyone is CPA, if you could help me understand what the heck that means, that'll be useful. I wanted to understand, but it was way beyond my head. But at least what I know is this is not a coming from the operations. So you may not see that same net income next quarter. Right? It was the most profitable Q3, yeah, because of the bump from the tax deferred stuff. So there were 3 strategic priorities. One is make hosting mainstream, means get active listing focused on making it easier for hosts to list their houses. So we are focused on making hosting as popular as traveling On Airbnb, our approach is working because active listing grew 19%. Means more and more hosts, they do want to host their houses on Airbnb. We continue to see double-digit supply growth across all regions and all markets. Airbnb hosts, they earn more than $19 billion. So make hosting easier. Number two is perfect the core service, which is to when you go and book a house or Airbnb, that's their core service. We have collected million pieces of feedback on how to improve Airbnb. So 2 years ago, they started doing twice a year product releases. So the next one is coming up. So they do one in fall and I think one in June or something. I don't recall. So since then, they've lost 350 new features and upgrades. And the one which I like the most is showing the total cost of stay. Prior to that, they only used to show the fee, but that doesn't include the cleaning fee. Now they've changed it because they heard feedback from their customers like you and I. You see the price of the room, it says you $200, and then when you start to book it, you figure out there's a $300 of cleaning fee. So eventually it become like $500. Doesn't work out for me. So now they actually start to show the total fee.
Vivek.
Yeah.
When I took Airbnb 2016, very bad experience. I kept on getting kicked out of places.
I don't know, but again, depend from host to host. My experience.
Oh, but I was never charged a cleaning fee. I was charged more than what was advertised, but I was not charged a cleaning fee. 2016.
Yeah. No, we have had good experience in all Airbnb stays. I would say one of them not so good because something broke on their water line, and we saw that from a kitchen there was a water seeping in. But then we contacted the host and they reimbursed because we had to vacate the house. But other than that, I think I've been pretty happy Airbnb customer. Only thing is that you have to be careful, and that's what I was saying, that when you try to book it, you see the total cost is way higher than what it was shown earlier, which Airbnb has now fixed it. Now they are also expanding beyond their core markets. Now they're going to, Germany, Brazil, Korea, these are now become the fastest growing countries as compared to 2019. So key numbers, which I want to focus on a business metrics is gross booking value, $18 billion, which is growing at 17%. We see the growth is slowing down, but still growing because now the base is becoming bigger and bigger. Nights and experience book is 113 million. Average daily rates, $161. Yeah, this is equivalent to ARPU for the social media company, right? But good to see that not only that they are growing, but they are able to per, the daily rate for the room is also growing. Right. From a financials perspective, operating margin 44%, all good. Share-based compensation, not too much. Yeah. So free cash flow is above $1 billion. So good to see increase in ADR, strong balance sheet with $11 billion in cash and $2.5 billion in long-term liabilities. Again, key trends. Like I said, it is growing, but not growing at the same pace. So the growth is coming down in the latest quarter. But yeah, I'm not too concerned about Airbnb, but not too much bullish as well. So my focus will still be, I don't think I'm gonna add at this price point where it is trading right now. Again, not a financial advice, but I'm just sharing based on what I hold in my portfolio. But I'll be willing to pick more at a lower price. And if it goes high, maybe sell something. Because it is growing. Here's the way, this is becoming more mature business, right? Which is great, but depending on what kind of investor you are and what are you expecting from your investment. So I'll still be, I mean, it's one of a top 15, right? Airbnb was there in the list. Oh, not this document. Was it? Did I have Airbnb? I think it is top 15. Not in there? Then it should probably is top 20. Didn't make to 15 yet. All right, questions on Airbnb. Any comments on Target store? I went there since 2009 compared to Walmart or Costco. They suck, very empty on traffic. I don't know which location you're going, but in San Francisco, probably if you're going to San Francisco, I'm not surprised that they're empty of traffic. They're just closing down the stores in San Francisco. And I think, and that I can say for many other stores, they're just closing down in San Francisco because of lawlessness and rampant theft. If you listen to any of the retailers' earnings call, they started to talk about shrinkage, right? Which is a euphemism for, the theft that's been happening in many of these retail. It's an organized theft, and I think not just San Francisco, but they are seeing it in many other places also, and now it has started to actually hit their margins. All right, so that was Airbnb. Next on roster is Palantir. All right, let's jump on to Palantir. This is one of those, I get a vibes of Tesla-like CEO. I mean, similar kind of a vibes when I listen to Palantir CEO in their earnings call. But let's go through that. We talked about this company start of the year. I mean, I've been following this for quite some time. And so far, so good. So what Palantir did? So quick summary on Palantir. It's I don't know how to classify this. This company, again, has been unlike the other tech companies. They love and they want to work with the government agencies, whereas the other companies don't want to work with government agencies like CIAs and those three-letter agencies. But this company says we are all for Western government. Their products have been mostly used by military and government agencies and that's why it wasn't more into on the commercial side, except last few years they started to move and sell more into commercial side. It's not a new company, pretty old, more than 20 years old company, but the products are something that no one else can match so far. Now they're finding again, there are these things every quarter I want to look into. Is one is their increase in the commercial side of revenue. Then what are they doing on a stock-based compensation? What was the third thing? Total, there were two things, right? And so started been following this since 2021. Did one review when they came up with the IPO. Did another review at the start of the year and found that it was too undervalued based on the business at the start of a year. So started building positions since then. All right, so now coming to Q3, they have a GAAP net income of $72 million, which is their fourth consecutive quarter of GAAP profitability that makes them eligible to be included in S&P 500. I don't know whether Standards and Poor's will include them or not, but at least now they're eligible to be included. Right. So GAAP income from operations was 40 million, but their total income, net income was 72 million. So 32 million came from somewhere else. So when I go and look at the P&L statement, I found out the net income. They have an interest income, just like we saw in Airbnb. They had an interest income. Because you can get 5% by just investing the cash that you hold on your balance sheet. So 32 million came from the non-business activity. Adjusted EPS was earning per share was 7 cents, which is compared with 1 cent the prior year. So that's a huge growth. The revenue grew 17%. More important is how are they doing in commercial? They grew 23%, which is what I like. As a valuation, if you are just onto the government, selling only to the government, you get valued like a government contractor. Then you don't get that, and that valuation is not the same as the valuation that you could get if you're a Google or if you are selling to the commercial companies. So good to see that they are growing their commercial revenue faster. The third thing we want to focus on the customer count. Right, how the customers are increasing. Now they've increased 34% year over year. Right, cash equivalent short-term U.S. Treasury $3.3 billion, which is a strong balance sheet. Adjusted free cash flow $141 million. So for a guidance, they're expecting between $599 to $603 million. I don't think anything to focus there. But let's look at management commentary, right? What are some of the takeaways? One was the AIP, which is their artificial intelligence platform. Today, everything is AI. If you're a tech company and not talking about AI, then be ready for your share to be punished. Even the non-tech companies are also coming and talking about AIs. After what NVIDIA had done, now all the valuation is tied to how many times you utter the word AI, right, in your earnings call. But when it comes to Palantir, they actually have a product. They have the AI platform, which they've been 2020, they were piloting it with customers. In 2023, they started doing boot camps. So instead of doing a pilot projects by giving a product to the customer does a pilot. Instead of doing that, they actually have a 5-day of a boot camp, invite customers to do a try out their product with their data, with their and real world use case, and see the benefit right there itself, right? So in the boot camps, customer attack the problems that have immediate impact and learn how to deploy AI in their unique operating environment in a matter of days, right? Which is very important. Also saw some great feedback from some customers. Some attendees said, one attendee said that we achieved more in a day with AIP than one of the top 3 hyperscalers. And when the hyperscalers means it's going to be Google, Amazon, or Microsoft, they had accomplished over the last 4 months. Another said that we basically built 10x faster with 3x less resources, right? So they almost tripled the number of AIP users, and this platform was unveiled only in May, June, somewhere, that. So good to see some traction. Other thing is a government web services new product, which allow, they launched only in September, which allow other companies to go and offer their services to government. By the way, Palantir is the only software company at IL level 5, which means these are different levels of security that you have to achieve. You have to start selling it to government agencies. Now, what they have done is to create like Amazon has Amazon Web Services. Now they're creating this start as a web service in which if I am a software company, I have not got this level of certification, and it's very difficult. It's not easy to get through the certification process. Minimum you need is a couple of $1 million. And if I'm a startup, I don't have that. And in my previous company, we actually thought we'll go through FedRAMP, and then we gave up because we were too expensive, gonna take too much time. And we said we're not gonna even look at the customers which are looking at a FedRAMP certification. But if this works out, that makes it things way more easier for other companies to go and start offering the services to Fed customers. I'll skip this, but basically the Alex Carr, who is the CEO, was very dismissive of the competition and the way the grift happens between the VC firms and the product and the companies in which they try to sell the substandard product, but their whole idea is to generate returns for VCs. So like I said, if you can listen to its conference call on YouTube, get a vibe of little bit of Tesla-ish kind of attitude towards the VCs. So big ticket size deals, during Q3, they closed 80 deals worth $1 million, 29 deals worth $5 million, and 12 deals worth $10 million. So, which is good. 3 key areas I want to look at Palantir: growth in commercial segment, so that it is not just a government contractor. Government contractor, you don't get good valuation by the street. So if you look at a commercial segment, commercial revenue grew 33% year over year, right? 37% commercial customer count grew. They have 102 commercial deals that they closed, and the customer count is like 10x in 3 years. Right? So I'm happy to see this 45% year over year growth in customer count. Other thing was shareholder dilution. Which is Palantir is one of the most notorious company when it comes to diluting the shareholders. They were offering too many stocks in a share-based compensation, which they continue to do, though it has come down from their previous quarters, but still 12% is too high. It's too high. So that's one negative that you need to be aware of if you're interested in Palantir. Third was, if you look at this is 12%. Third is I want to look at AIP, the newest platform. What's the progress? Which I guess they're doing a good job. So out of a 3, I think the most concern I'm about is still their share-based compensation. They have come down a long way, but 12%, come on, that's still too high. So the only reason for me, negative, which I still find in this company, is share-based compensation. It's still too expensive, and maybe they have to pay, because the kind of products they are building are not easy. So they have to pay to retain those engineers, and instead of paying in cash, they're paying in the stocks. But that's one downside on Palantir. It's too much dilution of shares. Well, that's on Palantir. I know some of you actually own Palantir. Started owning it probably when we talked about in Jan. How is Palantir did as a stock? It's been a pretty good ride. From, I think when we talked about it, was around $6. Today, it is around now 19. From my perspective, I feel it is too expensive at this price point. Revenue hasn't grown. I mean, the stock price has moved far ahead of revenue. I'm long-term bullish on this one, but if the Fed cuts the interest rate, there'll be a lot more money coming in. But otherwise, I feel it is expensive. It's not fairly valued right now. So stock has moved ahead of its business. That's my thought. So I'm not looking to add at this price point. Probably, yeah, if it falls down $3-4, yeah, I'll probably pick up something. And that is why the best way that I work on Palantir is selling strangles, right? So I think I have a 14-17 strangle and a 15-21 strangle in progress on Palantir. It's 19 is expensive. I see a chart. Coupang. Coupang reported results. Sam, what do you have for Coupang? They're gonna.
I thought when you talked about it, I put it in a buy,
Oh, sorry. Okay.
but I think I lost it. Did I put it a buy far off? Another thing, I found out I got WeWork warrants. I can't believe it.
So
Oh, that's $200 down the drain.
yeah, that WeWork was I mean, if you want to do in a WeWork, that was a kind of a lottery ticket, play money. I stayed away from it. Puneet, so what are views on high P ratio? Yeah, I think I just talked about it. I feel stock is currently expensive. I mean, you won't find good stocks at a cheaper valuation, but I think this is too expensive. Even if I look at, let me see if I can bring up the cash. Look at other metrics, even for a price of free cash flow, a price to sales itself is like 16.2, right? Which is expensive. So, yep, it's not reasonably priced right now. But we have seen in the markets when the stocks become unreasonable. Right? It's not the first time it's gonna be. So I just want to focus on how they're doing as a business. And if the business continues to work fine, stock price will take care of it by itself.
Excuse me. No, thank you for talking about it, because I forgot all about it. And then I look at my portfolio. I can't believe I have it. Thank you.
Right. Welcome. Two more companies. Let's look at maybe we'll look at the biggest one at the last. Let's look at Shopify first. Then we'll go to Apple. And that will be the end of today's session. Let's go to Shopify. All right, recent business highlights. They have a new retail plan. And the reason I highlight this is a new pricing plan for brick and mortar business selling primarily in person. Right? So Shopify, we all know Shopify as a company that helps businesses sell online. Right? Now from online, they are moving into the retail brick and mortar business. So I love these multimodal omni-channel players. I'll skip this one. They have a basically point of sale POS Go, a point of sale system Shopify Go. Now they're expanding it to UK and Ireland. Expanded our end-to-end cross-border commerce solution with the native merchant of record offering, Shopify Markets Pro. So they've launched expanded the Shopify Market Pro in US in the third quarter. Finalized commercial agreement with Flexport. If you remember, they had actually sold Shopify their logistics business to Flexport in a previous quarter. So it looks like now they finalized the commercial agreement that the goods will still be shipped by Flexport probably using the same network that Shopify had built and then sold it out to Flexport. So Shopify is no longer manage their own logistics. MercadoLibre still does it, but Shopify sold it. After 2022, when market was looking for every software company to reduce cost and conserve cash, this non-core business, Shopify sold it to Flexport. They announced an app integration that allows US merchants using Amazon Fulfillment Network the option to add Buy with Prime app from our app ecosystem into Shopify checkout, and the transactions also will be processed by Shopify payment. Essentially, they were giving us an update on their Amazon partnership that they had announced previously. Something new that came up with, they have partnered with Fair. It looks like and I did not know what this is, but it looks like it's a big player in business-to-business commerce in Europe. And they announced a global partnership with WPP to develop products and pair WPP expert network with their platforms. Let's go to the key numbers. Revenue is up 25% year over year. Gross margin close to 8% up year over year. 52% gross margin for, yeah, I think that's okay. Gross, I would say little less. I want it to be maybe around 60. Software company, I expect gross margin to be between 60 and 70. But free cash flow of $276 million, and that is against, previous quarter they were negative 228 million. From there to 276 million, that's a huge jump. Cash, almost no change, $5 billion. Business metrics. Now Shopify, as you guys recall, they have two major businesses. One is their subscription solution. The other one is their merchant solution. Subscription solution is where you go and take their subscription plan on what kind of a storefront you want, how many features you want. So you'll have different tiers of those subscriptions. Then the merchant solutions is the one where they will help merchants to manage their the merchants' businesses, right? Help with inventory, help with payments, help with your payroll and all that stuff. And managing your campaigns, managing your discounts and all that. So all that come into merchant solutions. So there were two businesses. What I want to see them, subscription is what get people in, merchants in, that's how they start with Shopify. And then when they realize that their Shopify business is growing, they start opting for more and more products from Shopify, which is basically the merchant solutions side of the house. So you would see more and more revenue coming from the merchant solutions, right? So subscription grew 29%, solution grew 24%, gross payment volume, Shopify Pay, that grew 31%, monthly recurring revenue is $141 million. Now, the thing to note is from a margin perspective, merchant solution is, subscription solution is a higher margin. I mean, there is nothing required. You just swipe your card and then you basically get a storefront, and that's why the margins are so high. Merchant solutions has got more work on their end and the Shopify end, so the margins are lower. So if you see, more and more revenue coming from merchant solution, the more percent of revenue coming from merchant solution, then there will be little impact on margin, but that is fine because the merchant solutions are stickier. I could have bought a subscription on Shopify and Postmates and some of similarly, let's say Wix.com, etc. And but if I bought a merchant solutions, if my business is integrated and dependent on Shopify, then as a merchant, I'll have that becomes a moat, right? That becomes my switching cost for switching my whole business from Shopify to another provider become way higher, because now I'm using Shopify not just to build a storefront and to sell the goods, but also to manage my rest of the business. Right? So if I move to Wix.com, how about my other business side? So I'll be still okay to have a lower margin profile, but increasing revenue coming from merchant solutions. Key trends, I think all is okay. I didn't have anything concerning here. Now, if you talk about a stock had gotten beaten in a previous quarter, because in a previous quarter they mentioned that they plan to grow, not QQQ, they plan to grow mid-20s. And if you're a growth company, market doesn't want to see you growing just in 20s. So markets had punished the stock. After the earnings were down 5% and then went to the slide, right? Now let's see how, then they provided their guidance. So let's see how they're done against their guidance. So guidance they provided was revenue to grow at low 20s, and they beat it because they grew at 25% this quarter. Gross margin to be approximate 2 to 3% higher, which they met. It was around 3% higher than the year over year. Operating expense to be flat to slightly up. That was a huge beat because operating expenses is only $1.5 billion as compared to $2.4 billion, right? It's not flat. It's not up. Actually, this is a huge beat. Free cash flow to be greater than the entire first half of 2023, which was correct. It's again a huge beat. It was 183 million. Now it is 276 million. So I guess market liked it, what they saw. And more importantly, their guidance was full year revenue to grow at mid-20s at year-over-year basis. Gross margin will be higher. So not only that we will grow, but we will also grow more profitably. Operating expenses will be down. Free cash flow will be high teens, and we will continue to deliver on this upward trend. Markets loved it. And I think the stock was up like 22% after this earnings. So looks like, at least right now, Wall Street is assuming that it is back on its growth track, right? And growing profitably. Right? That's more important. If you look at a free cash flow number, that's like, where is this cash flow? Yeah, from negative 228 to 276 million. One thing, anything which is a little concerning here is I think their share-based compensation, they still have 100 million share-based compensation. So take with a pinch of salt that the free cash flow is coming little being helped by that SBC, but so was the case in the previous year also. It hasn't increased its SBC. So I think that neutralizes the impact. That's Shopify. We're 9 minutes over. One last one, which is the biggest of all, Apple. Any questions on Shopify? And thank you for staying over. We'll be done with after.
What is share-based compensation? You have been saying that once.
So share-based compensation is very prevalent among all software companies, and I think this is the trend that started from Valley and now moved to other industries. Is if you join a company, they'll give you cash, plus they are also offered shares. It's pretty common in all the tech companies. So
yes, true. We get the monthly.
You get the shares, right?
percent.
So,
yes, correct.
Exactly. So where the share is, so it is a part of your compensation. So that's called SBC, share-based compensation. So every time a new employee joins, company is offering a shares to them. It means as a shareholder, as a business owner, my percent of ownership of the company is going down. If there were 100 shares, or overall 100 shares, and I own 10 shares, my ownership stake is 10%. Now you got a new employees and you created 25 shares, you gave it to them. I still have only 10 shares. Now total shares are 125. My ownership stake in the business is now less than 10%, or whatever the number comes out to be, maybe around 8%, 7%. So as a shareholder, I get diluted. So that's why I don't like share-based compensation. As an employee, you love that, but as a business owner of your business, I don't like share-based compensation.
But as a stockholder, like we are investing stock, how come it impact? So the philosophy what we get is, because we get the share compensation, we treat it as a members of the company ownership point of view. So employees can work more effectively, correct? Because if they work, the profit will increase and the share value also then. That may be driving factor for the employee point of view, correct?
So as an employee, they can also motivate you by giving cash, right? So at the end of the day, as a shareholder, if you, as a company, if you made, let's say, $1 million of profit and I own 10%, so means as a shareholder, I have 100K profit for me. I have a claim of 100K profit on it, right? But if you have diluted me and my now shareholding is only 8%, then my claim is only 80K. So as a, and we haven't yet directly found a correlation between increasing of profits and employee compensation. One sec. So that's why it started with the tech companies. Now it has gone to other companies also. As a business owner, as a shareholder, that goes against me. But as an employee, you love that. Right? But look at let's say some other companies. I think it's a Berkshire Hathaway. They don't pay any shares to their employees. Or was it some other company? I was reading about it. It's a great company, but they don't pay any shares to
Your
them.
voice is breaking.
Okay, I just see a message. Connection is unstable. Okay. All right. Is this voice okay now?
Now it's okay.
Okay. I see a comment. Are the charts available on investors page? Only you shared Melly also. No, these are the charts I started creating from this quarter. So these are my own. Finviz has a nice 3D value visualization of option prices. Jay said, yeah, I looked at when I logged on Finviz, it did tell me that something new on the option side. I didn't click beyond this. So maybe I will. All right, let's move to the last one. The biggest tech company. All right. Today, Apple is pleased to report a September quarter record revenue for iPhone and all-time revenue record in services, said Tim Cook. We now have our strongest lineup of products ever heading into the holiday season, including iPhone 15 lineup and our first carbon neutral Apple Watch models, a major milestone in our efforts to make all Apple products carbon neutral by 2030. So still focus on ESG. Our active install base has reached new all-time high across all products and all geographic segments. What else? Let's skip the rest. Management also warned that the revenue in the holiday quarter will be same as the last year. And markets didn't like it. So I wanted to dig deeper. So started looking at the numbers. And the reason why I started building this chart was visually, if I look at this, it gives me more information than if I'm looking every quarter, I go and look at their balance sheet or their financial statements. I was able to find the trend. So this quarter, I spent some time to start building these trends. So their key business metrics, if I look at America's region, not an issue, look at the services. Services has gone, I think this is the all-time high for services. Mac sales were down 34% year over year. And it has something to do with what Tim Cook had been saying during the call was in the last 2022, because of the supply chain issues in Q2, a lot of the demand was pushed down to the Q3 of 2022. And now if you're comparing with that high number, now we are seeing that the Mac shipments declined 34%. I don't buy that 100%, but it is what it is. Other thing is, if you look at iPhone growth, that is slowed down. 2 years ago, it was growing at 47% clip. Now it is a 3% clip. Only shining one is the services, which is growing at from 5% to 16%. Overall revenue is actually down for a quarter. As compared to previous quarter, it's actually down, right? So if you just look at this quarter, $89 billion great revenue, but I think when you're almost $2.5 trillion companies, it is difficult to grow at the same pace, right? So look at iPhone growth, almost none. Mac growth has been negative for the last 4 quarters, not just this quarter. So that's why I don't buy his reason of demand pushed down in Q3 in 2022, because how about Q2? How about Q1? How about Q4 of 2022? Right? So revenue decline again. If I go back and look at the revenue is the 4th consecutive quarter of revenue decline. So previous 3 quarters were declined by 1.4. So, and this was last seen in 2001. So it's been almost 22 years. Apple has now seen 4th consecutive quarter of revenue decline. Management said the iPhone sales are constrained not by the demand, but by the production capacity constraints. So it means if they fix the capacity is back up, they should not have any problem in selling the shares. Mac revenue expected to improve next year due to a new chip in the Mac line. Active install base is all-time high, and now they are looking at India to be the next growth driver. Regarding Vision Pro, which could be their next big thing, could be, I don't know. The product, during the demo, the product looked good, but still they need to build an ecosystem, and they actually have to build a different kind of ecosystem with it. So their go-to-market motion is going to be different. They're working towards it. Good thing that I liked in this report is share count continues to decrease. They bought back more shares. So while companies like Shopify, Palantir, they keeps on increasing the number of shares, hence diluting me, Apple has been buying back its shares. And so far, I think Apple has bought back 30% of the shares. So without me spending any further dollar, I become a bigger owner of the Apple as a company. They have $161 billion of cash and $145 billion long-term debt, which is huge, but I think Apple has got it at a very cheap price anyway. So with revenue not growing, I don't think it can be a growth story, right? Unless Vision Pro or some other new tech will gonna accelerate the revenue. So it's this company, again, this just my perspective, has moved into the phase in their life cycle wherein you become a mature company in which the revenue is not growing, but that doesn't mean the share price may not grow. There are other ways to increase the share price, which is become a dividend player, return the capital to shareholders, do a share buybacks. This is what exactly Apple is doing. For a company that is not growing, the revenue for last 4 quarters, 24, 28 PE is super expensive. Right? I think the only reason to do a de-investment in this would be that it will continue to bring down the share count and will give you business. The other thing is they got so much money and a big ecosystem that if they can bring a new product online, that could be a next driver. Right? So services was their, I would say, their game plan too. Like we talked about, right? What's your next act? iPhone was their act number 1. Services was their act number 2. We'll have to find out what their act number 3 would be for the long term. So yeah, market didn't like it. That's why the shares got punished. So they are not 4th consecutive quarter of revenue decreasing is not good. All right, that was the last one. So, we are 20 minutes over, so really appreciate you guys being here. Any questions? Pishan says, shop seems overbought. I mean, if you're looking at yeah, almost. If you're looking at the, I mean, for me to look at overbought, I look at these 3, CCI, RSI, stochastic, and it is reaching into overbought condition. I won't disagree. Looking at the technicals, short-term technicals, yes, it is almost getting into overbought conditions. Okay, any questions?
Yeah, sorry, I'm not typing fast enough. Are you having meetings on the 23rd of December and the 30th of December? Christmas and New Year's.
Yeah, I think definitely probably not a New Year. I don't know what's our family plan for Christmas is. Oh, but good reminder. Thank you for asking. There will not be any meeting on I have to travel on 18th and 25th. So I will cancel on meetup November 18th and November 25th. I'm traveling. So I guess we got just 1 week, and then you have 2 weeks off. And then I'll see you guys on December 2nd. Or maybe if there, let me ask you this question. Are you guys open for intermediate, like in between a week, not just Saturday? Because I won't be able, I'm traveling on 18th and then coming back on 25th. So there's no way I can do on Saturday. But if it works, then maybe I can do something on Wednesday and Thursday, figure out. Yeah, it will be on evenings. Yeah, on the weekdays, it will be an evening, maybe around 5 o'clock or 6 o'clock Pacific time. So we'll be a little late for the folks on the east side. Yeah, 4 or 5 o'clock. Thursday evening works. Okay. Yeah, I will put it up in the meetup. Yeah, anytime I schedule a meeting, I will be adding that in the meetup. Or if I'm not doing it, I'll cancel it on the meetup. So if you are coming through a meetup group, you'll get to know. Okay. Roku up 30%. Business that good? Yeah, Roku was, and I think after that, Roku moved another higher to, now it is up like almost 40% after earnings. I haven't looked at Roku recently, and I don't look at this particular earnings. So let's look at Roku. What did they do? Earnings release. Oops. Okay, total revenue 912 million. Platform revenue is up 18%. Gross profit is up 369. Streaming hours is what is, as a metric, will be more important. Streaming hours on active accounts, 26.7. Strong quarter. Active accounts net adds accelerated quarter-over-quarter for the first time. Streaming past 100 billion or 12 trailing months. We grew total net revenue 20% year-over-year. That's not that great. Okay. Q3 active accounts, ARPU. So what I like, at least in this one, is even though they are active accounts, what is Q3? Yeah, so oops. So active accounts was grew 16%. I didn't think about it. Their ARPU was down 7%, which is not good. How about their profits? The gross margin is down. Oh, okay. So they really cut costs heavily to basically increase their no, I didn't. No, that doesn't look to be the case. $718 million of this income. Okay, they need to fix this. I thought this was but no, they were like losing $147 million, and now they're losing 349. How come it's 138% year over year? It's like worse. I don't, how about a free cash flow? There is no information. Let's go down and see. Okay, this is better. Cost of revenue, gross profit is up, but not that much. income from operations. Ah, okay. So they got a huge amount of net income, net loss per share. Unless they have talked about something growing, really accelerating growth in their earnings call. Income statement is really bad. Let me look at the, have they generated a lot of cash? Where's 3 months? So they have been able to generate a lot of cash. Purchase property recommending. Yeah, from a cash flow side, they've done a good job. I think I've not looked into this, and I didn't look into their earnings script. Probably they must have talked about going back into the growth mode, and that's why the shares are up like 30%. The other thing is, Roku was also short. So there could be a short covering going on. These are the only two reasons, I think, because the current result is not that exciting. So as compared to the previous quarter, so either it has something they would have said in there during the earnings one. All right. Cool. All right, guys. Thank you, everyone. And we'll see you next week. Bye-bye.